Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your client's money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?
Hi guys, welcome back to the channel. Welcome back to the Greedy Trader channel. This is where we talk about all things trading. Now for those of you who are new to the channel, welcome aboard, and I hope you find incredible value as you go through this channel. What I'm really proud of as a content creator here on YouTube is that I always give you guys the best value I can possibly give you. I've spent over 15 years trading. I was in the professional space. I still to a degree am, but more or less in a different direction. And I like to think that over my time, I have really cut my teeth as a trader and an investor. And all I'm trying to do here today is pass that value on. Everything you see here is free. I'm particularly charging for anything. So, you know, when you come here, what I hope to give you is value. Now going forward, most of you guys who follow this channel for a while know that I talk a lot about my trading trifecta. And what's my trading trifecta? Well, effectively, I believe trading comes in 3 parts. While there are 3 things that we need to consider. The first being volume. So volume trading is critical. So volume is more or less that demand and supply picture. Liquidity, i.e. where is liquidity most available and where do larger traders want to take advantage of that liquidity? So liquidity is part of that. And the other aspect is time. A lot of people want to trade continuously through the day. It's not possible. Technically, you can do it. You can click the button. But are you going to be successful? Probably not. So I like to focus largely on the trading trifecta. So again, time, liquidity, and volume. So in this video, I'm going to show you exactly how I do that and how that's going to benefit you if you follow these steps. So if you've been struggling, you've been trying to work out, watching a ton of videos here on YouTube, seeing various different content creators telling you various different things, I'm just going to grind it down into 3 parts. And if you follow these 3 steps, I'm 100% certain, I'm not even 50, 60, 70, 80%, I'm 100% certain that your trading is going to change automatically.
If I can change,
Я думаю, что каждый тоже изменился
and
сегодня.
you can change,
Вы можете измениться.
everybody can change.
Каждый может измениться.
I'm not saying you're going to have to wait 6 years, you're going to have to wait 7 years. Trading is a continuous learning curve, agreed, but you are going to be able to get out of that rabbit hole more or less immediately. But you have to trust and follow what I'm about to show you. If you don't want to trust and you don't want to follow, that's perfectly fine. You can tune out of this YouTube video right now. I won't hold anything against you.
It's not a liquid! It's a great many pieces of solid matter that form a hard floor-like surface!
But if you're here and you want to learn, maybe you've been trying something and it's not been working and you want to try something new, or you want something, maybe you've seen something like this somewhere else and you want it re-explained, it just hasn't gelled, then stay with this video. I promise you, you are going to get value at the back end of this. If you leave now, it's kind of that thing, right? You've all seen the meme where the guy digs to the end of the tunnel and the diamond was just behind it, and then he just walked away, right? He had just one more hit of that pickaxe to get that diamond, but sadly he walked away because he's dug so far and he's just so disillusioned. I'm hoping my videos wouldn't make you feel that way. In any case, stick around and I'm pretty sure you're going to get the value that you came here for. Okay, so I'm going to use cable as a way to illustrate this. So cable is going to be my example. So yesterday, it was Monday. I have no idea why people traded Easter Monday.
What the fuck?
I just have no idea. Well, there was a market move, and the US markets were open, so fair enough. But we've just come out of a Good Friday, right? It was an early close in the options market, and you know, it didn't make sense for everyone to come and tackle this on a Monday. But I can understand retail traders were eager to hit that button you know, it's the way it goes. Okay, so let's take a look at cables. I'm just going to zoom in because I always want people to see this like really clearly. So let's look at the first part of my trifecta, which is volume, right? So we know that volume is the beating heart of the market, right? In fact, the market is there are lots of people who believe that the market is purely order flow. It is purely tape. There is nothing else to it. Like, you can watch anything else, but if you understand tape, you understand volume, you understand order flow, you're gonna succeed, right? It's inevitable, right? It's not easy, of course, granted, because the learning curve with things like tape, order flow, volume is very, very steep. And what I'm going to show you here today is going to be testament to that. So first and foremost, what I always do in the first part of my trifecta is try and work out like where the biggest traders are standing relative to the volume we can see. The easiest way to do that is to take the tick volume at the bottom of your screen that you can see and use that as a reference bar. Now, of course, if you have access to other type of volume data like level 2, for example, you can observe on the time and sales what's going on in the commodity futures market, for example. Pound sterling has an underlying, spot pound has an underlying futures, so you can use that as your benchmark if you prefer. If you want to get access to the futures market, you are best going off with a broker that will give you access. I personally use Interactive Brokers, but again, you know, there are lots of people who could provide you access to the futures market. Right, so we can see at 0100 in the Asian session, which brings you into the next part of my model, which is time. So the Asian session, it tends to be very weak on liquidity, it tends to be very weak on volume. So generally speaking, we don't see a lot of trading coming out of the Asia session. Now, of course, that said, yesterday was somewhat different. And if we look at typically the volume that we post in Asia, right, so I'm just going to compare that to the prior day, for example, and the day before that, you can clearly see that the volume in Asia on this day was particularly high relative to the past 2 days, right? And we can see the preceding price action, or I should say the preceding price action. We can see that the market closed significantly lower, right? So we had a close of 26.27 versus the open of that 0100 bar of about 26.37, right? Actually, more accurately, open is 26.37. So we have to deduce that a lot of the supply has to be at the higher prices, which should be around about sort of 26.42. So it should be up here some, right? So we have to denote that there's a lot of supply trading up at the Asia highs, right? So we can see for most of the early part of Asia, the market was long, and then we see a lot of volume, which denotes most likely liquidation, right? So people getting out their trades or profit taking, and that is backed up by more than likely a higher degree of short selling, right? So that's why we have a lot of volume trading in Asia. And then the market starts to go much lower. By the time we wake up in London, we can see now that we've seen a reasonable amount of demand, which is likely short covering from the Asian traders that were short. And that is easily identifiable because we have much higher volume relative to the earlier opens, 8 a.m. in London. So at 9 a.m, we have a big peak, right? So we can play dumb and say, well, we don't know if this is demand and supply. So we can then put a bracket and say, well, we assume that there are people short in the hole, as I like to call it, right? So it means they're short at the bottom of the market. They're people who are effectively long at the bottom of the market. That's perfectly fair. As we develop into the London session, we can see that the demand side was broken at about 11 a.m. and we had a solid close pre the US Open, which would be sort of the Nasdaq and the Chicago. So this is important, right? So what you've seen is that the supply remained in control across 2 sessions, Asia, London, and now we're seeing a break going into the US session with 2 open centers, both London and Asia, short, right? So everyone is short at this point in time. We do see a bit of volatility. So if we look at the lows, this was short-term liquidity low. So we do see we hit that and we try and recover in one session, but quickly trade back out, right? To close much lower at 26.01. Now, as we grind through, we open the Chicago session with a gap. This is really unusual. We often don't see gaps in cable, but hey, it's a holiday. See, anything can happen, right? So we get a big gap in cable, right? So what does that do? It invalidates the liquidity model. So let's say you were trading off liquidity. The market had traded short-term liquidity, which was prior day's low, and recovered, and you were anticipating this would go long. You're going to be wrong. Now, first and foremost, this was 1 p.m. right? So 1 p.m. is generally the New York Open, right? So effectively, this is not a very highly liquid session. 2 p.m. the Nasdaq Open is when all the stocks open. That tends to draw in a lot more liquidity, as well as Chicago, which is the main futures open. So if you take the bigger set of derivatives, which is the futures in Chicago, and then you take all the volume coming in at the back of the stocks, we are definitely going to see a lot more movement in those sessions than we're going to see, say, for example, in a London session, which is a much smaller amount of liquidity. So that's the liquidity model. We need to understand when the major center opens are and what liquidity they bring. So we've got liquidity and time now overlapping. So for me, I want to trade at the most liquid times, which has to be around about sort of the Nasdaq Open, or the London Open, which is liquid enough for Europe. Now, I don't like the London Open because it requires you to be a little bit quicker on your toes, and you have to be able to decide very fast. Whilst if you were patient enough to wait for Nasdaq Open, you can then look at the Nasdaq Open relative to prior US Opens and see where the volume is, and you've got a lot of time to observe that. So we can see that in London, the buyers were broken. So there's going to have to be some degree of liquidation at this point, right? So people are going to have their stops triggered. So there's that, more than likely why we had such a big reaction at 12, pre-market, 12 and 1 p.m. But once the Nasdaq is open, we should cross that bridge. And ideally, we should now be looking at the liquidity low, which was 25.87, right? So that's the other part of the trifecta, is that we got a liquidity low here, and we should be looking for a recovery. Sadly, we didn't get that. The market just grinded lower, and now we are extremely short. And effectively, we'll be looking to see what goes on in the prior London session. All right, we're going to come to that. But for now, so in terms of Monday, how would I have traded this if I was going to trade on Monday? Well, first and foremost, you woke up in London and you saw that you were extremely short. This wouldn't be a wise area to get short, right? So you can see 9 a.m. huge volume post. We can see that the 8 a.m. London opening range doesn't have a lot of volume, so it means we've got some weak highs here, weak lows, and then we can see that the market broke that demand, so the sellers are in control. So at this point, we can delete this little demand area here, accept that it's broken, and if we're going to execute on the short side, so we're going to be short in the hole, right, which is a bit awkward. I wouldn't be, because I'm approaching the short-term liquidity zone, and I'm also approaching liquidity zone in the US session, right? So this is not really a good area to be short. However, you'll be looking for a recovery. If you can see a recovery back, say, into the supply, then that becomes a great area to short. So I would have waited for a return. So in this day, I wouldn't really be a trader in the market, to be fair. And hence I wasn't. It's a Monday, it was a holiday. But if I was a trader, that would be my play. In this case, we didn't get that, but we are certainly confirming that the market was weak and we're going to get some more downside for sure, right? And that became evident the moment we gapped under, because now the lowest price of the day is below where the extreme volume is. So you can actually see that in the Nasdaq Open, we posted pretty much what was the highest volume so far. And we can arguably say that there were a lot of buyers here. And those buyers got flushed out naturally when we gapped under. And that's okay. Usually if you see that, we're gapping into a liquidity zone. We know these buyers have been stumped. The good idea would have been, again, to look for a slight recovery and then to go short. However, we didn't get that, we just continued lower. Now, it's very typical in markets like this on a holiday, where we start to see price action we're not used to. And a ton of people are going to lose a lot of money on these days. So, rule number one, sit out of holidays. It doesn't matter if it's holiday in Europe, because Monday is, but it's not a holiday in the US. It's more than likely that you're going to get weird type of price action as one group of traders, maybe from a specific market, take more control and trade the market the way they're used to. That is definitely going to exacerbate the downside of the upside. This is very common on holidays. So don't ignore this. Don't say to yourself that, well, it's just this guy talking on YouTube. This is exactly what happens, right? Professional traders often go away on these holidays and have fun, whether that's in Europe, whether that's in the US. So the feedback you get from specific sessions is going to change. Let's say in London, for example, the weaker volume, comparable to Asia, are all examples of lower liquidity, lower volume, lower interest. So overall, open interest in this market is low. And at this time, you can see that the break of the demand in London was an obvious sign that there were weaker hands here. What we were really seeing was a lot of short covering and people taking up that volume almost straight away to go back on the short side. This is not normal behavior for professional traders. So obviously the downside pressure from the London market clearly got followed through into the US market, and that continued, and then we obviously saw a gap. Like I said, gaps are unusual. I can't remember the last time I saw gap in cable in an intraday session, right? So all of this is an example that we are, technically speaking, in a holiday you shouldn't be trading, right? So this is how this day turned out, right? Let's fast forward to what's going on right now. So how would you trade this particular day? So we've had this big waterfall, we come up into a new session, and the first thing we notice is that 0100, just before that major settlement time in the international markets, we get a lot of what looks like demand. I think this is more or less confirming at 7 AM when we post slightly higher volume, pushing the market a little higher. So we can mark that out here again with continuing demand. Now the only way we're going to be sure is if we can close under this demand, which will be below 25.38. But for now, the market was extremely short coming into a new day. We're expecting some degree of short covering at the very least. We've also seen a reasonable amount of volume in Chicago, so there were definitely a lot of traders deciding that it's a good idea to hold long. Remember, larger traders probably don't even have stops, so we're not expecting any massive liquidation to the downside unless some news or something comes out that justifies that. So now we've kind of based out, post-market and coming into Asia. Most of the Asian session was relatively short. We expect a short cover, right? We do see increase in volume, 2 AM. We do see that there's pretty high volume. 7 AM, higher than Asia for sure. So there's early London volume coming in. And if we compare that to the prior day, for example, it's actually even higher than the 9 AM volume on Easter Monday. So someone is trying to take advantage of all the traders who are possibly short at this point. So now we get a recovery, right? So we break upwards. So this is a perfect opportunity to get long if you're available at that time. However, at 8 AM, we see additional volume coming in. Now, of course, it's slightly higher price. We are at an Asian liquidity high. We could potentially break again. So just so we get that confirmation, we would like to see higher prices posted just above the London Open at 8, which we do get. So this becomes a perfect long opportunity if you're looking to trade through London. But again, be aware, you are a little bit late because we can see there was early buying at 7. We can definitely see that London has confirmed that there is additional demand sitting at these lows, right? So there's people definitely jumping in. Any sellers on the supply side have now been broken. So now this should take us into the US session. Obviously, we're posting higher prices. Again, if we can reclaim the liquidity high, it's more than likely we'll start continuing higher. So how would I have traded this day? Now at 7 AM, having seen this and seen 8 AM pushing into new highs, I would wait for a slight pullback into the demand area, which somewhat came at about 9 AM. You can see us push back into that demand area, and I'll be looking at position long with stops below the 7 AM London volume. Right now, I would expect we're going to continue higher. So essentially, I would now be looking for much higher volume to confirm if we're going to get further downside. So for now, this is where the board is. I prefer to trade through the US session because we have the highest liquidity, we have the highest volume, everything in the US session. So again, we would expect this price action to either range here or continue into higher prices till once we get into the Nasdaq Open. Again, if we do drop back, I wouldn't panic. I'd look for demand coming in on the back of the Nasdaq in terms of a pullback. The only way I'll be interested in the short side is if we're trading under those London lows. Those will be quite extreme. So again, that is more likely to lead to a liquidity hunt, right? So as opposed to a full-on break, if we trade back down here, would likely test liquidity and rally. Now, of course, if you want to confirm what I'm saying, let's just see how the price action plays out over the next day or two. and then come back and revisit this chart, revisit this discussion. I'm always open to this, but to my next video, guys, adios.
Hey, listen, I quit. Yeah, I'm going into stocks.
Name of the game. Move the money from your client's pocket into your pocket.
But if you can make your clients money at the same time, it's advantageous to everyone, correct?
No.
No one is paying attention.
It's unbelievable.
Have to act now.
God, this is intimate. I feel like I'm financially inside of you or something.
Okay.
I have 5 houses and a condo.
I'm considering going long on April wheat. What do you think, Valentine?